Hello, this is Michael Moriarty, Chief Investment Officer of Wellspire. Welcome to the Wellspire Biannual Market Recap video. I'm joined by my colleagues, Dimitri Katz-Nelson and Chris Maxey. Gentlemen, lots to cover, lots of headlines over these last 6 months. Dimitri, what's front of mind for you?
I think we can't start this without talking inflation, right? So this is the probably safe to say that a couple of years ago the word transitory was used a lot, and it's much harder to say that it's transitory anymore. There's a lot of things happening underneath. So just to remind folks, obviously, in the beginning of COVID, we saw these supply chain bottlenecks come up in China, in the U.S., really elsewhere, and we had this shock of prices for goods, right? The things that we were spending a lot of money on because we were stuck at home and not doing other things. And there was an assumption that those would be transient in nature and would normalize over time. And I think what's happened since is it's taken much longer for the supply chain bottlenecks to normalize. COVID continues to be a mechanism to introduce closures and shipping bottlenecks in the U.S. and abroad. And so that piece kind of has gone from transitory to being a slowly transitioning. During that same time, we've seen more structural pieces come alive, whether it be wages, housing prices, and things of that nature. So as we move forward to today, and most of the recent inflation print being pretty high, we're seeing some of the transitory pieces roll over, right? We're seeing lumber prices come down a bit. We're seeing airline prices come down, things like that. But we also see housing continue to increase. We're seeing rental prices increase. So we're looking at higher inflation numbers for the foreseeable future. And that's really driving everything that's come after that. And I think probably the big thing is what's the Fed doing about it? And I think, Chris, you mentioned the other day, just a Fed quote from Powell that probably tells the story better than most.
Yeah, I think the Fed's doing whatever it can, right? So the Fed is saying inflation is high, we need to do something. The primary reaction mechanism for them is to raise interest rates. And what they've recently admitted, it was a quote from Jerome Powell, is that we don't actually understand a ton about inflation. So Powell said, we better understand what we don't understand about inflation. It was one of the most potentially confusing things I think I've ever heard, but at least they're finally admitting, hey, we don't understand a ton about inflation dynamics. But I think this is where we have a potential risk that the economy runs over the coming years, which is that the Federal Reserve is going to do what it can, which means that it's going to raise interest rates. And they're going to raise interest rates very aggressively until they see evidence that inflation is slowing. Up to this point, one of the other things that's happening, though, is the economy is moving towards a slowdown phase. And we saw in the recent quarter, the GDP was negative. There are indications GDP is going to be negative for a second quarter in a row. And yes, that's happening with inflation high, but now we do have the risk that the Fed is going to move us into a recessionary phase, which I know we'll talk about. So the Fed is doing what it can, which is to raise rates, bring down its balance sheet. At the end of the day, that does run the risk of moving us to a recessionary environment, and that's something we're keeping an eye on. Now, as we think about the markets, though, I know, Michael, you had wanted to talk about this year, how difficult things have been, no matter whether you were conservative or aggressive.
That's right, Chris. Frustratingly for asset allocators like us, nothing has worked at a high level, and there's been, quote unquote, nowhere to hide. What I mean by that is normally during risk-off events, yes, we expect, and clients have now become accustomed to expecting their equity portfolio to be down 10, 20, 25, 30, 35%. And we're there. We're down, high teens, low 20s in the equity portfolio. Normally that is balanced by typically your fixed income portfolio and some other assets, which typically provide the proverbial ballast. Fixed income's down double digits as well. Core, center of the fairway, investment grade, fixed income, because rates have gone up as much as they have. That's really whacked fixed income now. And as a result, whether you are relatively aggressively positioned, i.e. a lot of equity vis-a-vis fixed income, or relatively conservative, a lot of fixed income vis-a-vis equity, it almost doesn't matter. Your portfolio likely is down double digits as a result. So, that's the reality. I think as we look forward to potential recession, and I know Dimitri has some thoughts on this, likely fixed income has found a bit of a bottom, and we can look forward to some more robust performance going forward, given just the fact that you're reinvesting at higher and higher yields.
And Michael, I think you point to the recession question, and it's obviously where we get asked a lot these days. So a couple of things on that front. One, the markets are starting to price in a slowdown, not a full-blown necessarily recession, but you're seeing even in expectations of how aggressive the Fed will be here over the next few months. If you go out 12, 18, 24 months, there's a now market expectation that the Fed will start reducing interest rates during that time frame. And when does the Fed reduce interest rates? The Fed reduces interest rates when they're trying to spur economic growth. So there's this assumption already in the markets pricing in some kind of a slowdown. And frankly, the equity markets decline year to date is translating to market expectations of a slowdown. So we're seeing that there. I think a couple of things that are of interest is, we historically in the U.S. have never had a recession with improving employment picture, and the employment picture remains stubbornly strong, probably for some folks, which is an odd thing to say. But a lot of the things that would normally correlate to a slowdown, whether it be wages, whether it be employment, whether it be housing and things like that, remain quite strong. And fundamentals on the economy, is whether it's the corporate balance sheets or others, remain quite strong as well. So there's this presumed slowdown, which we're already seeing in the markets have priced it in. Just the question is what the severity will be and when that will happen. So we're obviously watching that very closely. I think one thing Chris has pointed out many times in the past is that there's a difference between an economic slowdown driven by kind of overextension of credit and the correction that entails. There's a massive economic slowdown that comes from that. We saw that in the financial crisis. We've seen that before, and we're not there, right? We're looking at different drivers for a slowdown, more inflationary driven, which tends to be shorter, which tends to be less dire, I guess, from just an overall growth perspective. So we're watching as that evolves over the next few months into year end.
Thank you, Dimitri. Thank you, Chris. Thank you for listening to the latest installment of the Wealthspire biannual market recap. Until next time, thank you.